the method is that you buy them while they're distressed. We give you the money to repair them, and then we have an exit strategy product, either a conventional loan or a DSCR loan that allow you to get qualified based on the property's ability to pay the mortgage and insurance and other things, rather than your own personal ability to do it.
Hello, everybody, and welcome to the Total Wealth Academy video podcast. I call it the video podcast because we also have our radio show podcast. You can find both at totalwealthacademy.com. And today we're going to talk about how to build wealth primarily with single family houses and how to do that by leveraging yourself with the best loans possible. One of the things people don't understand is that it is entirely possible to buy real estate for nothing down, absolutely zero down. The problem is people try to run their entire career off of zero down deals. I'm sorry, that's probably not going to work. Now, there's probably somebody out there who's done it who can prove me wrong, but I just haven't seen it. I think that you need to understand that there are different types of mortgages out there and that most people use the wrong mortgage. They're going to Wells Fargo, they're going to Bank of America, they're going to Chase, getting conventional financing to invest with, and that's the wrong way to do it. I can tell you that right now. That's an amateur's way of doing it. But first, I want to introduce Wade Como of Catalyst Funding. He has helped many of our members purchase property for zero down or very little down. But he's also an investor. I preach about this. Anybody on your team, I don't care whether it's your financial planner, your CPA, your attorney, your mortgage broker, I prefer them to be experienced real estate investors as well. I don't like dealing with somebody who says, oh, I'll be your CPA. Have you ever owned any real estate? No, I've never owned any real estate. Have you ever passively invested? No, I've never passively invested. Then you're not qualified to be my CPA. My CPA is not only a real estate investor, he's also a passive investor. Well, Wade helps our members buy properties, and he's an investor as well. So he knows what they're looking for, he knows what they should buy, and he can kind of be a coach through the process. So Wade, welcome to the show.
Yeah, very happy to be here, Steve.
Good to have you. Let's start off with talking a little bit about your portfolio. You're mainly single family, right?
Well, I have some passive investments in non-single family, but I'd say 90% of what I've done has definitely been single family. I actually owned a home investors franchise early in my career, and we did the full gamut. We did flips, added rentals, we wholesale deals, everything. So I think the most powerful thing that I did and my team did is that we added rental properties over time, and that definitely has been the most impactful part of that overall experience.
Yeah, people are not focused on buying assets. They're buying depreciating stuff, cars,
Hmm.
houses, personal residence I'm referring to. And they're just not buying assets. And when you do start buying assets like single family houses, it's life changing. It's like an epiphany. Like,
Hmm.
why wasn't I doing that before? It took me 3 years. I was wholesaling and flipping. And at the end of my third year, I got a mentor that just crushed me and said, you need to buy some rental property, Steve. And so I started buying the rental property, and he was right. That's where the wealth came. That's where the cash flow came. Flipping and wholesaling is really just a job. It's not
Yeah,
going to build you much wealth unless you save every penny. And we know that's not going to happen.
no, no. Yeah, I think adding the real estate portfolio, it had so many benefits, right? You get the cash flow, appreciation, significant tax advantages. And then whenever you go to raise money in other areas for different things, for example, I started a lending company, Catalyst Funding, and the fact that I had that on my balance sheet, that rental portfolio, greatly improved my position on being able to acquire the loans and to get better pricing over time as well. So there's so many benefits from building wealth through real estate that you really can't overestimate it because it's not only going to impact the simple things that people think about, like cash flow. It impacts your ability to do other things in life because your balance sheet is powerful. If you go into a bank, you provide a personal financial statement. It says you own a significant portfolio and you have appraisals that determine the value and you have that equity that's there. You have a lot more influence. You're able to get great products and do different things.
Yeah, it does. It builds your credibility. I know when I'm training syndicators to buy apartment complexes, one of the things I look for is did they build a single family portfolio first? Now, they
Yeah.
don't have to, but the majority of my successful syndicators who now own 200, 300, 4,000 units, when I trained them, they only had 10, 15, 20 houses. But I knew that if they could handle getting out there, busting their butt, and come up with 10, 15, 20 houses, they could run a doggone apartment complex.
Sure.
And it builds your credibility, of course, your wealth, builds your self confidence too, and that financial freedom that so eludes so many people because they don't buy income producing assets. So, how big is your single family portfolio now?
We've sold a good portion of them, but we're at about 53 units at the moment.
About
Yeah.
53 units. What
Yeah.
was it at peak? Was this during COVID that it peaked?
Uh, I mean, at its peak, we're close to 100. That was kind of the high side of where we were. Yeah. But it wasn't during COVID. It was actually a little bit before that.
And
Yeah.
then you
What's
sold
happened
them
over
during COVID
time?
because the prices were so high.
Yeah. I mean, at the end of the day, there's a wide variety of reasons to do it, but sometimes properties end up in a flood zone that weren't in a flood zone. This is rare, but sometimes taxes increase at a level that is greater than the rent increase. So it's so funny. Like you start off with a portfolio and you try to pick winners and losers just like you would in the stock market. Sometimes you're completely off base. Like it doesn't, there are things that are outside of your control, but I think it's important to constantly reevaluate your portfolio. Can I move some of this money into passive investments? Can I buy different single families? You just want to look at it because while cash flow is only one of the factors, if factors outside of your control make that a non-cash flowing asset, it's better to allocate it elsewhere. And that's some of the decisions we've made.
Interesting. How many passive deals are you in?
Three passive deals. Yeah.
And are these all apartments or,
Self-storage.
oh, all self-storage? Yeah.
Yeah,
I,
yeah.
I really like self-storage. I remember when I first got exposed to it, not realizing that during a recession, self-storage goes up
Yeah.
because people are moving out of their houses and storing their stuff. It was just like apartment rental rates went up during the recession. So did self-storage rental rates go up during the recession. So you end up making a lot of money even in the down times, which of
Yeah.
course longtime viewers know real estate makes money in both the up and down markets, and that's one of the reasons why.
Yeah.
Well, next, let's talk about catalyst funding and how you help investors get the lowest down payment possible. Um, why don't you describe your investor loan for someone who's buying a single family house to fix up and then rent?
Sure. So we try to be a one-stop shop for real estate investors that are either wanting to flip properties or to hold properties long term. And then we also offer a wide variety of products that allow them to maximize their buying power, their dry powder. I'll kind of walk through all of those. First of all, we provide the money to purchase and repair distressed real estate. That's called hard money or private money loans. And we will give you the money to buy these properties that you really can't use other products to buy that allow you to buy homes at a discount. For example, if a property has major roof issues or foundation issues, you're not able to go in and use a traditional financing loan from a bank or certainly conventional loans or VA loans or anything of that sort because it won't meet the minimum qualifications. With hard money loans, the method is that you buy them while they're distressed. We give you the money to repair them, and then we have an exit strategy product, either a conventional loan or a DSCR loan. DSCR means debt service coverage ratio, and these are no income doc loans that allow you to get qualified based on the property's ability to pay the mortgage and insurance and other things, rather than your own personal ability to do it. So I think the thing that we do is we try to have an efficient process with trusted advisors, like you mentioned earlier, where we can help you go from this property that's distressed, help you fix it up, and get to the other side where you hold it in a long-term product that allows you to have a cash flowing property.
Well, a lot of people, now that you bring up the conventional and DSCR loans, a lot of people are afraid that they can't buy multiple houses.
Sure.
But Fannie Mae is actually set up where you can buy your personal residence and 9 rental properties. It's actually set up for you to do that. And then once you reach the 10 loans, then you switch to DSCR, or what other types of loans can they move to once they've used up their Fannie Mae's?
DSCR is definitely the best product, in my opinion. There are some bank products. The unfortunate thing with bank products is that you're often going to have to provide a personal financial statement every single year. And
Yeah.
they're normally products that are like on a 5-year arm, probably a 15-year amortization, maybe 20 years. These are true 30-year fixed products, just like a conventional loan whenever you move to DSCR. And although they may have longer prepayment penalties, like conventional loans don't have prepayment penalties, if you're willing to take a longer prepayment penalty, the interest rates and terms can actually be very comparable to conventional loans at the moment. And for most people, I think what you preach and a lot of other mentors preach is that you really want to hold these properties for 3 to 5 years anyway, and then do one of two things. You either want to refinance to get cash out to fuel your real estate investments, or you want to sell them. So having a little bit longer prepayment penalty, but getting very attractive terms whenever you get beyond 10 is a very reasonable thing. The other alternative would be potentially putting them into a portfolio loan or a blanket loan. The only thing I would be cautious about in that category is that you have to be very cautious about the release provisions, because there are some of these blanket or portfolio loans which will make you put you in a very difficult spot whenever you try to sell properties. Like, you're not going to be able to decrease your indebtedness as much as you would if you were selling individual properties. So you always want to look at the release provisions if you're going to entertain a blanket or a portfolio loan.
Yeah. And then on the DSCR loans, is it usually a 3 to 5 year prepayment penalty or shorter, or what?
With Catalyst, one of the great things about us is we have 9 different delegated underwriting authority DSCR loans. That means that we're able to basically internally underwrite these. A lot of our competition, they have to go outside of their organization because they're brokered loans. That adds time and a little bit of uncertainty for the real estate investor. But to circle back around to the DSCR timeframes, we have zero prepayment penalty
Oh,
options
wow.
to 5. Now, in order to get rates close to conventional loans, you're going to have to be on the upper end of those prepayment penalty terms, probably close to 4 or 5 years. But if you're in a position where you're like, I want to either be able to refinance in a year or two because I think rates are going down, or I want to sell this property in a year or two, there are definitely products available. You just are probably going to have higher rates and fees.
Understood. Well, let me explain a deal that I did, and then you can build on it with whatever you think I missed. But when people think zero down deal, they think, you know, I remember reading articles where you trade a pickup truck for the down payment, or
Right.
uh, just all kinds of crazy stuff that's out there. But these loans can actually be zero down because they're weighted. You're doing up to 75% of ARV. Is that correct?
Yes. And that's an important nuance here that investors want to understand, is that we're not evaluating the property to determine the loan amount based on where it sits today. It's not an as is appraisal. It's a subject to repairs appraisal. So you as an investor will provide something called a scope of work or repair budget. And the appraiser will take that and he will compare to what the property will look like when you are complete with your rehab. So in other words, if you say this home is in really bad condition, or it's in pretty good condition, but just dated, but you're going to do a lot of things to it. In other words, you're going to put new cabinets, you're going to put countertops, you're going to put new appliances, maybe you're going to put new siding on the exterior, new roof, whatever the case may be. The appraiser is going to look at what you have described and then compare it to other properties in that area that will look like your property will when it's done. So it's a subject to repairs appraisal. Let's just say the property now, as it sits, is worth 100. You're going to put 50 into it. And at the end of the rainbow, it's going to be worth 200. We can lend 75% of that 200. That means 150,000. And you would just be, in that case, bringing the closing costs on that transaction. Well, let's say you get an even better deal. You buy it for 100, you put 40 into it, and we're willing to lend 150, 75%. You can actually roll in 10,000 of closing cost if there are that much. Usually there's not, but if there are, you can roll that in. Maybe you roll in your insurance, your flood insurance, whatever the case may be, and you can be completely zero out of pocket on that transaction. It's all about the value of the property and the price point at which you buy it and the repairs needed to repair it. If those two things in concert, in combination, the purchase price and repair budget are below that 75%, you can literally be zero out of pocket.
Yeah, let me make sure this is clear for everybody. So everybody, please pay attention when I say this. If the house is worth 200 and you can buy it and rehab it for 150 or less, that's a zero down deal.
Yeah.
So the example I was going to give, a little property here in Houston, very similar numbers. It was worth a little over 200. I was all in, closing costs, holding costs, everything at 170. Well, my hard money loan was 150, so I only had to put $20,000 down on that deal, just the difference between the 150 and the 170. I did a calculation. If I had used a conventional loan, that deal would have been $67,000 out of pocket.
Yeah.
$67,000 out of pocket. That's why you need somebody like Wade on your team who can keep your down payments low. Because I was able to buy 6 houses and have $7,000 left over. Did I say I was able to buy 3 houses? Sorry.
Yeah.
3 houses and have $7,000 left over because of the hard money loans to conventional. And
Yeah.
then, like Wade said, you only use the hard money for about 3 months, 4 months till you're completely done with your rehab, and you refinance it into a permanent loan, 30-year fixed mortgage. It's just a powerful, powerful way to buy rental property. It's also a great way for flips too. But
Mhm.
remember, flipping is a job. We're talking about building long-term wealth, so we're kind of focusing on the rental property at this point. What's the biggest hard money loan you will go to? Will you do more than 4 units?
No, we cap out at 4 units. We really try to be subject matter experts and provide the best products, the broadest group of products in that space. Single family, 1 to 4 across the state of Texas for hard money loans. Now we'll go national on long-term loans, but we stick to the state of Texas on that single family 1 to 4. And we have a wide variety of products to both do hard money and refi. Conventional loans, you can go up to 75, 80% on those 1 to 4 units. It's a really good way in which to add more doors, and that still just counts as one property, right? So if you do a 4 unit, that's one mortgage, and you can have, as you said earlier, up to 10 mortgages as an individual. And there's some other hacks you can do there as a husband and wife. You can maybe put the property in one of your names, and you can get up to 19 investment properties and one primary residence. So there's a lot of different ways to maneuver that. But at the end of the day, in the current environment, the DSCR terms are so attractive. A lot of people just go straight to DSCR because it's a little bit easier as long as they're comfortable with that prepayment penalty.
Yeah, and I always would be because I'm never going to hold a house for less than 3 years unless I just get some insane offer on it.
Right.
And then it'd be worth paying the prepayment penalty, I'm sure.
Yeah.
Um, in the near future, 2026, I know I'm asking you to crystal ball it a little bit, and nobody's going to hold you to this, but I'm thinking that 2026 is going to be a great year for both single family and apartments. I think there's going to be a tremendous amount of opportunity to add stuff to your portfolio. What are your thoughts about 2026?
Well, I think there's several reasons I think it's a great market too. Rates are not the only factor, but I think we're going to have some wind at our back in the rate environment for next year. Um, you know, the current administration is really passionate about lower rates, and there is going to be a change at the Fed chair. And I tend to think that The administration wants to put in somebody who's probably in large part already committed to some rate reduction. So that's some nice wind at our back in the rate category, which is always a win. But beyond that, in the state of Texas, there are so many people moving here, and not just individuals looking for jobs, but there are so many job creators moving to the state of Texas. It's absolutely incredible. They're looking at coming out with a wealth tax in the state of California. People are moving out of there with reckless abandon right now, and that these are people from Silicon Valley or other parts of the state that are not just going to move them and their families, but they're going to move an enormous amount of jobs and opportunities. There's a lot of companies from other, not just in tech, but other parts of the country that are moving here as well. So you look at the number of homes that are going to be needed to live in, right?
Yeah.
And we just don't have enough inventory here. So there's going to be not only better flip opportunities, I think, in this upcoming year. It's been a little bit of a difficult flip market, but as long as you bought deep, you can still do well. We have a couple of investors who are crushing it. They're just making sure they buy at the right point. They put out a great product. They're doing well. But I think that category is going to do better. But then I think even more for landlords, because a lot of these people moving to the area, most people don't want to buy the first year whenever they move somewhere. They want to get to know the area, or maybe they don't have the wherewithal to buy at the moment. So I really see rent rates increasing in 2026 and being a great opportunity for landlords.
Yeah, the apartments we're seeing, a lot of people are having to sell because they've got adjustable rate mortgages. They're coming due. So in the multifamily or commercial, I think we're going to see a similar situation where there's just tremendous opportunity to go in there, help these people get out of these loans and get a good deal at the same time. So I think it's going to be a heavy investor year. So I agree with you and I appreciate your thoughts.
Yeah.
Tell people how to get a hold of you. What's your website, phone number?
Yes, the best way to reach us is to go to our website. That's Catalyst FDG or catalystfunding.com. You can also just Google Catalyst Funding. Then the best way to reach us via phone is 832-648-3626. But you can also find us on social media. We also do an excellent monthly market update with fantastic guests like you yourself, Stephen. You're often join us there. So if people want to get a little bit more information on the Texas market and the real estate market nationally, we'd love to see you over at our monthly market update.
Sounds good. Yeah, those of you who have been using conventional financing as an investment tool, I'm telling you, reach out to Wade, let him show you these products, and you'll see why every house I buy, I use a hard money loan. And every house that any member at Total Wealth Academy buys is a hard money loan from Wade or someone like him. So Wade, thanks a lot for coming on the show today. I sure appreciate it.
Yeah, thank you, Stephen. Have a great one.
You too. All right, everybody. Thanks for watching. Again, if you want to find out more about Total Wealth Academy and our mentoring program, there's a link below to come to our free sample real estate investor class. We'd look forward to seeing you there. Thanks a lot.
Thanks.